2 weeks ago, there was a lot of concern about the war between Israel and Iran escalating. What's your read on the situation and how it would potentially affect oil?
You could get to scenarios where you see $200 oil prices, and you would almost surely get direct U.S. involvement in there to shut that down and make sure that the straits are reopened. And they more than likely would have the support of China at that point. Also could have a direct attack on Saudi facilities that, lasted for, months and took months to repair, that could take prices up over $160 a barrel.
We'll be focusing on commodities today, and in particular, oil and gold, two assets that have already rallied tremendously since the beginning of the year. Is there more room to climb, or is this it in the rallies for now? We'll find out with our next guest, Bob Ryan, who is an expert on commodities research. He is the chief strategist of BCA Research's commodity and energy strategy. Prior to BCA, Bob spent nearly 2 decades working in the commodities markets at Clarendon, Bankers Trust, Goldman Sachs, and Deutsche Bank. He is also a veteran of the United States Navy. Welcome to the show, Bob. Pleasure hosting you. Honored to have you on the show. Thank you for joining us.
Thank you, David. Great to see you again, truly.
Yeah, excellent. We used to, not work together, but we were at the same firm at BCA many years ago. So I was a great admirer of your work then. I still am. So great to host you now. Bob, let's talk about eco data that came out today. Oil slid a little bit on the GDP release, which came in lower than expected. As you know, GDP came in at 1.6%. The consensus expectation was 2.4%. Do you think oil was pricing in a slower growth rate in the economy?
I think, once you look at net exports and the stuff that counterbalances with the downdraft in the report today, you're probably back to being close to where the Atlanta Fed expects GDP to be, which is about 2.8% growth for the first quarter. So we'll see how it plays out, and it's also good to remember it's preliminary, so it definitely is going to be revised.
Inflation, however, the PCE inflation data came in a little bit harder than expected. That is the Fed's preferred. Core PCE is the Fed's preferred measure of inflation. This certainly doesn't bode well for expectations for a cut anytime soon. Do you think the markets, stock markets in particular, are going to react to this news negatively over the next coming days or weeks?
Yeah, I didn't check the equities, David, but the commodities in response to that, the GDP and the PCE inflation. They sold off a little bit, and then they traded back to where they were beforehand. Again, we'll get more data on PCE, but it does look stronger than people had expected, and it may, if it's confirmed, it could push back a rate cut or maybe 2 rate cuts back to September, that time frame, away from June, July, which is what we're expecting. But we'll see how it plays out. A lot of this stuff is still working its way through the system, like higher auto insurance, higher medical costs. That stuff is not going to it's not going to keep inflation elevated.
Well, how much of this higher inflation print was a result of the higher oil price that we've seen over the last 2 months or so?
I don't think a lot. I haven't looked at it, in terms of the contribution, mostly from gasoline, which is what people, look at. And it's the reason everybody has a view on oil, because everybody's filling their car. But I don't think it's had that much of an effect. We've averaged something like $82 in the first quarter, and our forecast for the second quarter is about, a little over $90, so maybe $92 for the second quarter. It is not until we get into the third quarter that we expect to go over $100 on oil, and that might give a little bit to headline inflation for PCE, but even there, it's not going to be that huge. And in real terms, if you look at historically, $100 is not what $100 today is not what $100 was 5 or 10 years ago.
So you're saying that, well, we'll get to your oil price outlook in just a bit, but this recent correction then, is it short-lived then? It's not on its way down towards a bear market for energy?
Um, yeah, I don't think so. We to get to demand destruction in energy, like where prices take off and they really start contributing to these inflation gauges. Particularly for what consumers are most concerned about. So gasoline, diesel fuel, and nat gas prices, which are extremely well behaved. You need to get gasoline prices up above $4.50 a gallon to really move the needle at all on these inflation gauges, as well as to get people to change their behavior. So we're a ways away from that. We're averaging something like 370-ish in the US for gasoline, regular gasoline now. We'll be going into the driving season in about a month. And you'll see it probably move up to $4 a gallon. But even there, people will be somewhat, frugal, but they're not going to change their vacation plans. They're not going to change their lifestyle. Get over 4.50 a gallon or closer to $5, then you really start seeing behavior change.
What does that translate to WTI in terms of dollars per barrels?
Probably maybe $105, $110 a barrel thereabouts is when things start to the needle starts jumping around a little bit.
Would there be a price point for crude oil at which the economy starts to slow, which is to say that consumers really start to spend less on driving, travel, leisure, and perhaps businesses start cutting back on spending because their base energy costs are higher?
Yeah, I think that number, where you really start to have that effect on behavior is probably $120 a barrel. That's what when we model this stuff out, that's where we get to mostly. So, if the OPEC plus folks and the producers outside of that, mostly in the U.S., since they're the margin and they're the swing producer as well, somewhere around $100 is an ideal setting for producers and consumers. Once you start going through 110 and you're on your way to 120, the Saudis and the UAE are going to increase their production and try to keep it down. They don't want high prices because of the demand destruction. That if you started making your way toward 120, that would certainly ensue. So it's a fine line, and a lot of the power around how that whole thing evolves is now in the hands of the OPEC plus producers, most especially Saudi and the UAE.
2 weeks ago, there was a lot of concern about the war between Israel and Iran escalating to a regional war, if not, in the worst case, a global war. It doesn't seem that way for now. What's your read on the situation and how it would potentially affect oil?
In exactly the way you frame the question. So we just published some research. What is today? Thursday. So we published some research today looking exactly at this. And this is not a time to be complacent. This is, the situation is still very fraught. You could easily get to an expansion of hostility, more kinetic war environment in the Middle East. And, it could find its way into the Gulf. And that's where it really starts to get people's attention. Anything that threatens the Straits of Hormuz, anything that threatens, Saudi production or UAE production or Iraqi production, because it has to go out of the Gulf and through the Strait of Hormuz to get to the market. The market really stands up and takes note of that. If the conflict stays in the Levant, so in Gaza, in Lebanon, or something like that, the market will be on edge, and because there's always a chance that Iran becomes directly involved, and Iran and Israel once again confront each other. So, I mean, there's all these, um, what's the word, tripwires that could set things off. So, what we did in this week's report is say, okay, what happens if we see, this happening? And my colleague, Matt Gherkin, who runs our geopolitical service, I'm sure you've talked to him, laid out the framework for this, and then we, ran it through our models if these things happen. And, in some instances, like if you shut down the straits for a month, the Strait of Hormuz, you could get to scenarios where you see $200 oil prices, and you would almost surely get direct U.S. involvement in there to shut that down and make sure that the straits are reopened. And they more than likely would have the support of China at that point, because China gets, somewhere north of 40% of its oil out of that part of the world. You also could have a direct attack on Saudi facilities that, lasted for, months and took months to repair, that could take prices up over $160 a barrel. Or, you could have the U.S., really deciding to lean into enforcing sanctions, against Iran exporting its crude oil. Right now, Iran is exporting like a little over 1 million barrels a day. And that's, there are Trump era sanctions in place that are not being enforced by the Biden administration. If for whatever reason they decide to lean into that, it's probably the least damaging of those three things that I just mentioned, like the closing of the strait, the attacks on Saudi production. But it would still, push prices above 100, probably into the 120s at that point. And then you'd start to see Saudi and the UAE releasing their spare capacity. They hold most of the spare capacity.
I've heard the opinion that the U.S. Is trying not to get involved because they don't want to push the oil price up to much higher levels during an election year. Could you evaluate that?
Sure, I think that's true. I think the Biden administration is doing everything it can to keep the market from pricing in an oil supply shock of any sort that would send crude oil prices higher, which would drag gasoline prices higher with it. If we were to see that, then without a doubt, you would see voter dissatisfaction with Biden and his administration really increase, and it could cost Biden the election. And that Russia is trying to get that done. So there's a lot of things that the administration is trying to keep from entering into the oil pricing environment ahead of this election.
Can you just explain in maybe perhaps layman terms why a conflict in the Middle East would today move the oil price higher and cause, in your words, potentially a supply shock, given that now the U.S. is, I guess, on an independent country basis, one of the largest, if not the largest producer of gas because of shale, whereas 20, 25 years ago during the Gulf War, that wasn't the case. So why is it that tensions in the Middle East would move oil when the U.S. has the ability to just produce its own oil?
Sure. Oil is a global market, and literally, ships literally move to where the price signal tells them to go. And, the U.S. has been a big exporter of oil now that it's been, and natural gas, because you say, that once that oil or natural gas gets on the water, unless they have a direct contract that they're meeting, the owners of that cargo, whether it's a producer of the commodity or if it's a trader of the commodity, whatever, is going to look for the highest value point on the planet to send that. So this is a global market. And the other thing that's really important is, even though the U.S. is, nominally independent, the oil that's produced in the U.S. is very light and very sweet. So that means it's very easy to refine, and it's very low sulfur. And the refineries in the US are all configured to run the heavier sour stuff, so much harder to refine and much more sulfur in it. And that most of that comes from the Middle East, the stuff that the US is using, or from Canada. And once you threaten that supply, you're threatening the supply of the feedstock of the refineries in the US Gulf, which is where most of the US refining capacity is located. And that's when the market starts to really twitch, because we can't run all of the domestically produced crude oil in the domestic refineries of the US. We have to import that from the rest of the world, largely the Middle East and Canada, like I was saying.
Just
And
out of curiosity, how long or how much investment would be required to build refineries or amend refineries to refine locally produced or domestically produced gas?
that would take a lot. I mean, there's been a lot of capex going to that, but it's been slow. I don't think we've had a new refinery put up in the U.S. in it's like 40 years now, I think.
Yeah.
A lot of it has just been, refurbishing them, and adding a capability to take on more of this lighter, sweeter crude that's produced domestically.
At what point do you think the U.S. military would have to get involved in the Middle East between Iran or Israel or any other proxies?
They already were involved in taking down those Iranian drones and missiles that were lobbed over toward Israel. So, they're already in one way or another engaged. To really get full-on kinetic, in the Middle East, any attempt to shut down the Straits of Hormuz would immediately cause the U.S. Navy to get involved. So, that would be a full-on war, just to clear it out and to, stop that disruption. So that, that's 20% of the world's oil that goes through the Strait of Hormuz. The world can't live without that. So the Navy would get in there, and, they'd probably send some, ground troops in as well, but it would be sorted in short order. And that's one of the things that we think, our geopolitical services, as well as us, or me, in the commodity service, we think that's one of the things that's restraining Iran. Iran does not want anything to do with full-on war, with the U.S. getting involved that way.
It wouldn't benefit them in some way to have higher oil prices?
Definitely. If they could continue to export, I think that's the binding constraint.
Sure.
If a blockade is put on and they can't bring anything in or out, game over.
Yeah.
So it's not going to help them.
Okay. Given that your short-term to medium-term outlook for oil is up for now, what do you think the Fed's going to do about it? Are they looking at oil to make monetary policy decisions?
Yeah, they look at it. I think that it's really interesting that there was some work done at the ECB, and I think this was like 2 or 3 years ago. Talking about oil, not only as oil prices, not only as the the value of a commodity that's been exchanged, but it impacts a lot. It impounds a lot of economic information in that price formation process. So central banks look at it. They look at what's happening in the oil options market. Ben Bernanke wrote a paper a long time ago now, like back in the 2010, either side of that, talking about how options markets have a lot of information. So they're very aware of that. And when you look at inflation expectations and how they're formed, more than a few studies have shown that oil and gasoline in particular are highly correlated with inflation expectations. And they also feed directly into the actual inflation that we all experience. So, we're all trained to talk about core inflation, right? That's what the central banks want everybody to focus on. But households drive cars, they buy food. So excluding food and energy from your inflation gauge is meaningless to households, because that's what they focused on. So these central banks are all, very dialed into that. And yeah, so they do pay attention to it.
Let's move on to.
They don't always get their assessments right.
No, that is what I've heard. Yes, their track record is rather inconsistent, to put mildly.
Me and you.
Okay. Well, let's talk about gold, which is a commodity that does respond to inflation expectations. It's been the price has taken a bit of a reprieve from its top, from 2,400 now down to 2,300, 2,340 as we speak today. Bob, what's next? Is my question.
We're pretty bulled up gold, David. So on gold, our next target. We went through our first target, 2,200 an ounce earlier in the year. We raised the target to 2,300 literally within a week or two. It took that out. So now we're at 2,500 as our next level. The big drivers in the short term, obviously, are the Fed. Is the Fed going to cut rates? And anybody's guess right now, given you started your show with the observation on the GDP report plus the inflation report. The economy is really strong right now. The economy, the variables the Fed looks at, and the Fed is the all-important central bank for gold, right? Gold is denominated in USD, and it is incredibly sensitive to all the things the Fed cares about: real rates, dollar, the dollar exchange, inflation expectations. All those variables, are things that the Fed watches, and they get embedded in gold prices. So what happens next? The market's going to wait to see if growth is too strong for them to cut. That's the big question right now. If we don't get, a 25 basis point cut in June or July, do they move it back to September? Do we go the whole year without a cut? I mean, these are the questions the market's trying to resolve right now. A lot of things are working in favor of the Fed right now that are really important. Like the U.S. productivity is going up. We've got a lot of immigration in the U.S. that is expanding the labor force, bringing more skills in, creating more demand. That's a really positive tailwind. So, with the productivity boom and higher inflation, higher immigration, you get, more output, and you get more of it for the same number of inputs. So all that stuff is good. And that argues for, well-behaved inflation, or maybe even lower inflation. But at the same time, you're starting to see, and then over the medium to long term, you're going to see more concern about this. The deficits in most developed economies, the debt to GDP ratios and the annual deficits of these governments is doing nothing but going up. And that is inflationary, because the risk is that the central bank is forced to accommodate that debt and monetize it. So increase the money to supply to keep the cost of the debt, the nominal cost of the debt down, keep interest rates lower by increasing the amount of money in circulation.
I'd just like to
people are worried.
I'd just like to share a chart with you and the audience, Bob. So this here is gold in the gold is the bar line in this particular case, and the DXY is the orange line. Traditionally or historically, they've moved in opposite directions with a pretty steady inverse correlation. Over the last month or so, they've moved pretty much in lockstep every step of the way that I can observe. This is not normal. What's going on here, Bob?
So it is very rare, and that's a great chart. It's very rare to see the dollar strengthening as well as gold strengthening. We saw this once before, and usually what you're getting is a flight to safety when you see that. So now the safe haven demand is coming on the back of not only this, really strong fiscal expansion that's occurring in all the DMs, but particularly in the US. So debt and deficits are increasing, but, we're looking at trade wars. Secretary Yellen was in China. Secretary Blinken is in China right now. A lot of the tension in that relationship boiled out into public view when Yellen was there. So, people are seeking a safe haven in that regard. So the geopolitical risk, the inflation risk longer term that comes from this, we call it fiscal dominance, but just central banks monetizing the debt that's building up on the back of all this, stimulus that's coming through fiscal policy. So these are long-term, effects. And then you got one thing that's really, really interesting. And right now it's like kind of, um, people know it's there, they can see it, but they can't identify who the players are. So there's a really strong bid for gold in the market right now globally, and a lot of that demand is coming out of China. A lot of it is coming out of central banks. So Russia is getting very upset that the banks in the West that are holding its foreign reserves are going to seize those foreign reserves and use it to fund Ukraine's war effort. Every other central bank in every other country in the world is looking at that and saying, that could be us. The banks that have allied themselves with Ukraine could literally freeze our assets and take them and use them to, fund whoever is fighting a cause that the West supports. So now, you've got a really strong bid coming out of central banks for that very reason, and another very strong bid in particular coming out of Chinese households and traders. And that is, a really powerful force working its way through the market. So you got all of these, just a laundry list of things that are supporting gold and making it ignore the very strong dollar. I mean, that's the bid is in the market. So, the next thing to watch for is that, do the central banks persist in buying even as the price goes higher? If they think it's going to go even higher, they do. If they don't, if they back away and say, no, this has just gotten crazy, we'll know, and you'll see the bid leave the market. But right now it hasn't. Before we got on together, I saw it was, gold was trading at about 2330-ish, thereabouts. So it's only down about 3% from its all-time high, from a week or so ago. So, and that's with the dollar still rallying, and that's with the Fed still saying, or the markets, pricing in a higher probability that we're not going to see any rate cut at all this year. The economy is that strong that we're not going to see another rate cut. So, I mean, it's fascinating, man. It's really a fascinating time.
So you mentioned central banks buying gold. You're right. The trend of buying gold from central banks has continued into 2023 and 2024. We also saw repatriation of gold right after the U.S. froze Russian assets. Is this part of a broader theme or trend of de-dollarization? I know that's a very broad concept, but are you observing other evidence, should we say, of de-dollarization happening around the world?
Yeah, I think you will. I mean, at the margins, you're seeing more transactions being done in yuan. Not to the point where it's like a big mega trend, but that still continues. And the gold as well. I mean, there you don't have to worry about currency conversion risk. Gold is gold. And, it's been a medium of exchange and a store of value for like 5,000 years or more. Got a good track record.
Finally, I want to ask you which commodity you think will perform the best over the next 12 months or so from an investment standpoint. In other words, what are you most bullish on?
I would say copper, and then gold, and then oil, in that order.
Copper's already run up, I think, I was checking the charts the other day, 17% year to date.
Yeah.
So you think there's going to be more room to climb? Why?
Yeah. We were Uh, I think we were talking about it today. Oh, we had a client call, and one of the questions was, you know, from the way it looks like the world is going to need as much copper in the next 10 years or so, or 10 years now, as it needed when China was doing its huge infrastructure build out and all of its manufacturing build out. And that's about right. Right now we consume about 26 million metric tons of copper a year globally. 45% of that's done in China, and that ratio is going to start increasing in all these countries, particularly in the DMs, as they move into the future. So we estimated a while ago we'd have to double refined copper output, double it by 2030. S&P came out with something, after that, and they said it's more like 2035, but the ratio was still there. A doubling was needed. So, that's going to be really important. And I think that, today's news, the news that BHP is bidding to take over Anglo American, largely because of its copper assets, draws a lot of attention to it. And I think this is probably, that's the opening shot in a race to control more copper at the mining level and at the refining level.
Does it concern you? Final question, I'll let you go, Bob. Does it concern you that a lot of the copper is produced in, I would say, high risk, politically sensitive jurisdictions, DRC, South America, which has had a history of nationalizing assets, in China even? Is the U.S. looking at this from a strategic standpoint and saying we have to start ramping up our own domestic production somehow?
Yeah, without a doubt. The U.S. Department of Defense had, at the beginning of this year, like at the end of January, beginning of Feb, they rolled out the first ever industrial policy for the Department of Defense. And one of the things that received an enormous amount of attention was getting control of the critical minerals supply chains, from getting it out of the ground to shipping it to getting it refined and getting it into the firms that are using it to build out this military capability. That is front and center for the US. It's front and center for the EU, and it's front and center for China. So you've got the three largest economies in the world, and two of them have been already engaged in a defense build out, but that's China and the US, and now the EU is funding higher defense spending as well. All of these guys need critical minerals, none more so than copper. And if they want to continue to do the renewable energy build out, they're going to need more copper. So I mean, this is a long-term story. This is, we'll be talking about this 10 years from now, Dave.
For sure. Okay. Excellent insights, Bob. Lots to follow up on in the coming months, I'm sure. So we'll have you back to update us on commodity news. Where can we follow your work in the meantime?
At BCA Research, we publish weekly. Sometimes we publish these big reports like we did today. So just bcaresearch.com. Can find us.
Can you just maybe give us a teaser as to what you're working on next, or some ideas you have in the pipeline for your next big report?
Yeah, we're working on natural gas and the linkages with the electricity market. So the demand for electricity in the world that we're living in right now, with AI and all of the the demand for electricity that's going to come from running processing centers, warehouses like of the sort that DHL and Amazon operate, and the huge amount of investment that they're making in these AI technologies. These things are huge energy consumers, huge, and that is really going to be the next big wave that we're all talking about pretty soon.
Perfect. Thank you very much, Bob. We'll speak again soon.
It's my pleasure.
Thank you for watching. Don't forget to like and subscribe.